All right, let's talk about Summit Midstream because their second quarter results were a real head-scratcher. You've got what looks like a great report on the surface, but the market's reaction, well, that told a completely different and, frankly, pretty brutal story.
So, what did that story look like in numbers? Well, this. A drop of over 16% in a single day. We're talking August 12th, right after their earnings call. This wasn't some gradual sell-off, folks. This was a sledgehammer. A clear, decisive verdict from Wall Street.
And that right there is the big question, isn't it? I mean, how on earth does a company boost its revenue by nearly 40%, sign these massive decade-long deals, and then watch its stock just fall off a cliff? It doesn't seem to add up. So that's what we're going to do today. We're going to unpack this whole thing.
Okay, so to really get to the bottom of this, we've got to look at the two sides of the coin. First, the results the company was so proud of. And second, the market's, well, less than impressed reaction.
Let's kick things off with the company's side of the story. And look, on paper, it's pretty compelling. You see revenue just jumping up 38% year over year to over $140 million bucks. Even their earnings per share, while still in the red, got a lot better. I mean, you look at just these numbers in a vacuum and you're thinking, wow, that's a solid quarter.
But then you look at this. This is what the market had to say. While the spreadsheet looked great, the stock chart was a bloodbath. It opened the day above $24 a share and just tumbled, closing down near 20. And this, right here, is where things get really interesting.
Now, to really get inside management's head, you have to know their favorite metric, Adjusted EBITDA. You've seen it a million times, right? It's that number they all love that pulls out interest, taxes, all that stuff, to give you a picture of core profitability. It's a big deal in the energy space, and Summit was quick to point out they generated $61.1 million of it.
So you can imagine the earnings call, right? The stock is tanking, and management is up there saying, hey, ignore the noise. Forget about today's stock price. Look at what we're building for the long haul. They really tried to shift the focus to these big strategic wins.
And what are those wins? Well, they're not small potatoes. We're talking a brand new 10-year deal in the Williston Basin that literally doubled their average contract life there. Huge. Then in the Permian, another 10-year agreement for their Double E pipeline. And maybe the biggest catalyst of all, in the Arkoma Basin, they have an anchor customer firing up a 20-well program. That's going to be a massive volume driver come 2026. These are the kinds of deals that build a company's foundation.
And it wasn't just about the new contracts. They also kept pointing to their backlog of DUCs, drilled but uncompleted wells. They've got over 100 of them sitting in their system. It's kind of like having a pantry stocked with food you just need to cook. The hard part's done. It's a built-in inventory of future business just waiting for the switch to be flipped.
Okay, so long-term deals, a pipeline of future work, management's case sounds pretty solid, right? So why the heck did the stock get crushed? Well, now we have to look at what the investors were really hearing. They heard all that good stuff, sure, but they fixated on the cracks that were showing up right now.
And the smoking gun is right there in the CEO's own words. He said that $61.1 million in Adjusted EBITDA was, and here's the key phrase, slightly below expectations. And he blamed two things, some timing issues with wells and, this is the big one, lower commodity prices in the DJ Basin. That's the phrase that sent up all the red flags for the market.
And when he said lower prices, he wasn't kidding. It was a complete price storm, especially in the DJ Basin. Just look at this. The price they were getting for residue gas fell off a cliff, down 40% in one quarter. NGL is down 10, condensate down 15. When you're getting hit like that, it doesn't matter how much volume you push through the pipes, your margins are going to get absolutely crushed.
But honestly, all of that might have been forgivable. The real killer, the line in the press release that probably did the most damage, was this one. Because for investors, the past is the past. It's all about the future. And what did management do? They took a knife to their full-year guidance.
So they went from this pretty wide range of $245 to $280 million in Adjusted EBITDA to telling the street, yeah, we're probably going to land near the low end of that. That is a massive red flag for investors. It's basically saying, hey, those problems we had in Q2, they're not going away anytime soon. It completely resets the narrative for the rest of the year.
Okay, to really get the full picture here, we need to zoom out a bit, because what happened this quarter isn't just a random event. It's all happening against the backdrop of a huge strategic shift for the company. Remember, they just converted from an MLP to a standard C-Corp last year, which was a big deal designed to make them more attractive to a wider range of investors.
And since that change, their game plan has been pretty clear, really boiling down to three things. 1. Go out and buy smaller, strategic assets that fit right into their system. 2. Lock in those long-term, fee-based contracts we talked about so they're less exposed to wild commodity swings. And 3. Just get smarter and more efficient with the pipes they already have.
And you know what? To their credit, they are actually doing it. You can see it right here on the timeline. The deals for Tall Oak and Moonrise closed. They got added to the Russell indexes, which is great for visibility. And they've laid out a clear path for when big projects, like that double E connection, will start generating cash. The plan isn't just a plan. They're putting it into action.
So, where does that leave us? You've got this fascinating tug of war, right? A company that's clearly executing on its long-term vision, but is hitting some very real, very painful speed bumps in the short term. So let's wrap this up. It's time for our verdict, the next call. And our call is market perform. Plain and simple. What does that mean? It means we think the stock is probably going to track along with the rest of the market for a while. It's not a buy, it's not a sell. It's a wait and see that perfectly captures the conflict between that long-term promise and the near-term pain.
And here's why we landed there. On the plus side, you absolutely have to give them credit for de-risking the business for 2026 and beyond with these new contracts and acquisitions. But on the negative side, you just can't ignore the headwinds they're facing right now. The commodity price risk is real. The guidance cut proves it. So our prediction? Expect the stock to basically go nowhere, just chop around in a range until we start seeing some real hard numbers from that big Arkoma program.
But what if you're not the wait-and-see type? For anyone looking for a more interesting angle, this whole situation might open the door for a pretty clever contrarian trade. A way to bet on Summit's future without getting burned by the market's current fears.
So here's the idea. You go long Summit Midstream. That's your bet on their specific catalysts, like Arkoma and Double E kicking in down the road. But then you hedge that bet by shorting a basket of natural gas producers, the companies that have zero protection from weak commodity prices. What this does, in theory, is let you play for the company's specific upside in Summit while protecting yourself from the exact macro risk that got everyone so spooked this quarter. It's a classic pairs trade.
So there you have it. Summit Midstream's second quarter is a perfect example of that classic Wall Street battle. A messy, complicated present versus a potentially very bright, contract-backed future. Where the stock goes from here really just depends on which of those two stories investors decide to believe. And of course, just a reminder, this is for informational purposes only. It is not financial advice.